XPeng and Xiaomi are showing us in two different ways what success looks like in the EV market. XPeng is doubling down on aligning leadership incentives with returning value to shareholders, while Xiaomi is demonstrating how operational excellence and having ecosystem first movers advantage in that regard can really help out and really be a win in their sales. The common thread though, both of these companies are focusing more on fundamentals than hype. Instead of having gimmicky things and running campaigns and doing extras, they're really focusing on take cars out of it. How do you run a good business? What's integral to that? Now, XPeng wasn't always doing this. They made the shift, but now that's their focus, and they're reaping the benefits of that. Xiaomi is doing that from day one in their automotive business, and it's showing in a major way. We're finally seeing a shift across the entire industry, and that shift is towards tangible results and accountability. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's poppin', everyone? My name's Obi, and welcome back to Courtside Financial, where we break down the latest in business and technology. Today, we're going to be talking about the EV sector, a sector that we talk about pretty often. Going to be talking about NIO a little bit, Xiaomi, and XPeng. Quick reminder before we dive in, too far, NIO's earnings call is going to be Friday, March 21st. I'm not going to say it again because you guys know what that date means to me. I don't want to be redundant, but I will be out in Toronto doing some things, so I won't be able to give swift coverage of that, but I will be tuned in. I will be listening. It's super important to me as a NIO bull and an investor. So with that being said, hit the subscribe button if you guys don't want to miss my take on it, my breakdown. Whenever I am able to get that out, it will probably be early next week. Now, yesterday we talked about the major shift happening in the EV industry, the delicate balance between innovation and profitability. Today, I want to explore something kind of similar, how EV companies are putting their money where their mouth is, quite literally. We've got two major stories that caught my attention today. First, Xpeng CEO just got offered a major stock grant worth $328 million. But here's the kicker, he only gets it if he can drive the company's stock price up by 700% in the next decade. Talk about having some skin in the game. And second, Xiaomi just dropped what might be considered the strongest financial report in its 15-year history. And that's coming off of a lot of that is coming off of their innovative automotive division, generating 32 billion yuan in just half a year. So definitely not just impressive, definitely also transformative. So let's break these down and what they tell us about where the EV market is headed. So first, let's talk about XPeng CEO's compensation package. The company's board just approved a plan to grant XPeng CEO Xi Jinping 28.5 million shares. At today's prices, those are worth about $328 million. But, and this is a big but, he can't just cash out on these shares whenever he wants to. The deal is structured in tiers. He gets 1/3 of the shares only if XPeng hits 250 Hong Kong dollars for 30 consecutive trading days. That's almost triple the current price. Another third unlocks if it hits 500 Hong Kong dollars for another 30 consecutive trading days. And the third and final, only if it reaches 750 Hong Kong dollars, which is more than 8 times today's price. And if he doesn't hit these targets by March 2035, the entire grant then becomes worthless. That's a decade-long incentive structure structured to kind of align the CEO's interest with the interest of shareholders. Now, what does this tell you about XPeng and the broader EV landscape? Well, a few things jump out to me. First, this is a vote of confidence from XPeng's board. You don't offer this kind of package unless you believe that the company has long-term potential. Remember that Xi Jinping already owns all of XPeng's Class B shares, which means that he has 69.5% voting power. But this isn't all about control, it's about financial incentive. Second, it signals that XPeng is thinking in decades, not quarters. In yesterday's episode, we talked about Xi Jinping's ambitious plans around robotics, flying cars, and their expansion into multiple vehicle segments. This compensation structure reinforces that long-term vision. Third, and perhaps most important, it shows a shift in how EV companies are approaching the way that they incentivize leadership. It's no longer just about giving executives stocks. They're now asked to deliver specific measurable results. Let's compare this to what we're seeing at NIO. NIO's founder, William Li, has consistently maintained a significant ownership stake, but NIO hasn't announced any similar performance-based compensation packages tied to the company's share price. As we look forward to NIO's earnings call this Friday, March 21st, one question I'll be asking is, how are they incentivizing leadership, especially in this critical phase that NIO is going through? Are they aligning compensation with the profitability goals that they've set for 2026? It's worth noting that Xi Jinping is putting his own money on the line as well. Just last August, he purchased 1 million shares on the Hong Kong market and another 1.4 million ADS through his wholly owned company. So folks, to me, that's conviction, and it seems to be paying off. Xpeng shares are up around 100% year to date. The market is clearly responding positively to their strategy shift towards operational efficiency versus having the most sound or stellar technology at all costs. Now let's shift gears to our second major story, Xiaomi's extraordinary financial performance, particularly in their automotive division. Xiaomi's revenue for 2024 reached 366 billion yuan, up 35% year over year. That's not just good, it's great and exceptional for a hardware company of their size. For context, Apple and Tesla only grew 2% and 1% respectively last year. But what really stands out is their automotive business. In just half a year of production, they've generated 32 billion yuan. And here's what should make NIO and other EV makers nervous. Xiaomi's automotive business had a gross profit margin of 20.4% for Q4 last year. Think about that. A company that just entered the automotive business is already posting better margins than Tesla, NIO, XPeng, Li Auto, and Tesla and Li Auto, by the way, are two established players known for their operational efficiency. Remember all the jokes about a Xiaomi being 99,000 yuan before they launched? Well, who's laughing now? The average selling price of a Xiaomi vehicle is 234,000 yuan, approaching Li Auto's 276,000 yuan. And their flagship SU7 Ultra is priced at 529,000 yuan, which sold 10,000 units within 3 days of its launch. So this isn't just a successful pivot, it's a complete reinvention of Xiaomi's brand positioning. They've torn off the budget brand label and transformed into a premium player overnight. What I find particularly interesting is the synergy between Xiaomi's automotive and phone business. After their dual Ultra press conference where they launched both the SU7 Ultra and the Xiaomi 15 Ultra phone, sales of their flagship phone jumped 80% year over year. This is something that NIO's been trying to build with their lifestyle brand and NIO houses, but Xiaomi already had the ecosystem advantage from day one. Their car business isn't cannibalizing their core business, it's enhancing it. Now let's talk about profitability though, because this is where things get interesting. Despite those impressive margins, Xiaomi's automotive business still posted a 6.2 billion yuan loss. I've seen shallow analysts claiming that Xiaomi loses about 46,000 yuan per car, and they got to that conclusion by simply dividing that number by their 136,000 vehicles sold. But as some have pointed out, that's a wildly simplistic way of looking at a company that's in the automotive manufacturing space as they are trying to ramp up and achieve scale. The reality is that Xiaomi's losses are narrowing quarter by quarter, from 1.8 billion yuan in Q2 to 1.5 in Q3 and down to 700 billion in Q4. That's the type of trajectory that you want to see. Li Jun just announced that they're raising their 2025 delivery forecast from 300,000 units to 350,000 units. Based on what we've seen from other EV makers in China, the break-even point usually falls somewhere around 360,000 to 400,000 units. Connect those dots and you can obviously see that Xiaomi is reaching profitability in their automotive sector a lot quicker than their competitors, possibly even by late 2025 or early 2026. So what does all this mean for NIO and the broader landscape? First, the bar for success just got higher. When Xiaomi can enter the market and almost immediately achieve a 20.4% gross profit margin, it puts pressure on other established players and players who have been there for quite some time to deliver results and deliver them a lot quicker. Second, the ecosystem advantage matters. Xiaomi being able to tap into the ecosystem that is built out for over a decade gives them the ability to leverage an existing customer base and already have a retail presence, proving to be a significant competitive edge. Third, the days of dismissing new entrants are over. 2 years ago, many analysts laughed at Xiaomi's automotive ambitions. Now they're forcing the entire industry to take notice. As we look towards NIO's earnings call on Friday, I'll be focused on how they are planning to navigate this competitive landscape and reacting to these things. Can they maintain their premium positioning when companies like Xiaomi, with obviously deep pockets and ecosystem resources, etc., are quickly establishing themselves efficiently in this space? NIO still has advantages: their battery swapping technology, the ecosystem that they've created, and their loyal user community and first mover advantage in several technologies do help out, but they still need to demonstrate that these advantages do in fact turn into strong financial performance. Before I wrap up, let's connect these two stories. XPeng and Xiaomi are showing us in two different ways what success looks like in the EV market. XPeng is doubling down on aligning leadership incentives with returning value to shareholders, while Xiaomi is demonstrating how operational excellence and having ecosystem first movers advantage in that regard can really help out and really be a wind in their sails. The common thread, though, both of these companies are focusing more on fundamentals than hype. Instead of, having gimmicky things and running campaigns and doing extras, they're really focusing on, take cars out of it. How do you run a good business? What's integral to that? Now, XPeng wasn't always doing this. They made the shift, but now that's their focus, and they're reaping the benefits of that. Xiaomi is doing that from day one in their automotive business, and it's showing in a major way. We're finally seeing a shift across the entire industry, and that shift is towards tangible results and accountability. Anyways, that's going to be it for today's episode of Courtside Financial. I thank you guys for tuning in, for watching. I may put out a video tomorrow, I may not, but make sure you hit the subscribe button, and I will see you next week on the Courtside Financial podcast if I don't see you later on in the week while I am in Toronto for my birthday. Have a good weekend, everyone. Really enjoyed hanging out with you guys. Bye.